All right, so welcome to Trader Tuesday. We've already got 9 questions submitted. We've got this, brief half hour here together. Um, this is a open Q&A. Please use the Q&A box. You'll find that on the Zoom window rather than the chat. To submit your questions for me, we'll take them first come, first serve. And let's hop right in. Use the chat for general, follow up and things like that. Tibby asks, how quality are fresh condition shifts due to news? News is not something that I factor into my particular NADRO trading, but I'm well versed at trading, news and catalysts and whatnot. So for me, the quality isn't affected really by news. That could be different for you, right? If you, like I have a student right now who's, interested in fundamentals as a component of what they're doing, looking for those key macro themes and drivers, and then they're using NADRO as a timing vehicle, right? So if you have a great catalyst and you're timing it well, some people like to trade that way. So that's just great if you'd like to do that. Tomas says, hi, Merritt. Can you share your thoughts on bet sizing on different setups? I've watched some interviews with top traders. They all share the same view of betting much more on their A plus setups. Is this something that you're doing as well? No, it's not. And a lot of the better traders I know don't do that. I think it's, how can I put it? Everybody wants to be bigger in the trades that work really well. Okay, so there's a lot of dynamics here. Either a lot of traders out there are trading things that they should not be trading, taking setups that they have no business taking, and then when their real trades, which they happen to call A plus, show up, they trade bigger. Okay, I guess that's one way of doing things. To me, that doesn't make any sense at all. Why are you taking all these probably negative expectancy, all this other junk? What I work with a lot of, guys on my desk, students in the NADRO community, let's get rid of the junk. Let's only focus on your best trades, and let's be consistent about how we size those. I've had conversations with Brett Steenbarger on this. He is in full agreement with me. If you know which are the best trades that you take, maybe you want to get bigger in those trades, but maybe you need to cut out a bunch of other stuff. So I'm not the kind of trader, some traders I hear take feeler trades where they just kind of nibble at something small. They're just getting a feel for things. Look, either the setup is there or it's not. Either risk reward is really skewed in your favor and you see something on the tape and the momentum shifts and you want to hit that, or not, with in my world. So no, I really do disagree with that. Now, I get asked this question a lot. So some of you, I'm sure, have heard me answer this. There are special situation traders, right? You may have a really huge expectancy on a very certain specific thing, and you're trading like, some form of inefficiencies in markets. And yeah, maybe there's home runs there to be had that are sized up in. My advice that I'm giving is to technical day in and day out traders just grinding out an edge that is based on just, looking at charts, maybe a little bit of news information, things like that. Okay. So there are different types of traders out there doing that. So Tanush has a good follow up here in the chat. He goes, well, Merritt, you change your trade management based on quality of the setup, right? Pretty much, yes, right? So if I'm in something, let's call more A plus, right? And to me, A plus is really derived from the contextual situation, the risk reward landscape, the confluence, the freshness, how we define strength of narrative. And so for me, it affects trade management. I will hold more size for longer, right? Or at least attempt to do so. I will hold more of a core position. I will scale out less quickly, right? Whereas the other end of the spectrum, I'm just kind of taking what I call a scalp, which might be just based on short-term stuff, order flow. I'm going to be really heavy in scaling out of that. I'm going to be quick about taking those profits and scaling out of that. So that's a really good point. I've been doing this a really long time. No matter if it's A plus or A or B trade or however you want to do that, I don't really use a grading system like that personally. I have no clue, and I've never met anyone who knew with any degree of certainty which one of the next trades, whether it's an A or a C, were going to work or not going to work. Okay. I've never met that person ever. And I've met a lot of traders. So to me, that pretty much ends the argument. Again, outside of special situation type traders who are doing very unique things. For people who are technical traders, or even a combination of fundamental and technical, who are trying to trade directionally, right? Trying to time markets. It's a coin flip on the next outcome. There could be huge risk reward on the table or small risk reward on the table, but the outcome of the loss is essentially 50-50, or in my case, 40-60 against me. So I really don't want to have a situation where I have a couple good trades and then I really load the boat on something and I lose all of, that's the type of trader who, and think about it, where we have psychological stuff going on as well. You get convictions and ideas for whatever reasons. And you all of a sudden are the type of trader who's heard these, people say, oh, I really size up in my best trades. Again, that trader probably has a problem in doing too much outside of their best trades, right? But you open up randomness to the extreme of now all of a sudden one trade, which is just another coin flip as to whether it works or not. Now all of a sudden that hurts me for 3, 4, 5, 6 R relative to some of the smaller trades that I took that I was less quote unquote convicted about. Especially for you guys who are probably on this call here, who are probably all amateurs, probably all trying to find your way. You have no business trading that way. That's my opinion. I think it sounds sexy. I think a lot of people like to talk a big talk about sizing up and, getting big in trades. There's nothing more sexy, a trader could share with other traders, right? But, anyways, those are my thoughts. It's a great question. I think it's an important one. Oh, kind of hate to answer this, even though it's a great question, Christopher, because I answer it a lot. And so I'm sure a lot of our audience has, but hey, you're here to get your answer. So how has your trading evolved over time? What are the common themes that caused the discovery and evolution? Is there any aspect you're currently working to improve upon? So, how much time do we have here, right? My trading has definitely evolved. I'll just hit the high notes, stocks, then Forex, then futures. So I could trade on a Forex on a regulated exchange, which opened me up to then various commodities and indices as a whole. and that's kind of where settled. In terms of strategy, it was initially find the magic indicator or combination of indicators, right? Um, Read everything I could get my hands on. Um, from there, I kind of started to realize, you know what, I don't need the indicators, or better put, there's nothing magic about any of the indicators. Let me focus on being kind of a price action specialist. If all these indicators are just derivations from price and maybe volume, right? Let me focus on price and maybe volume. So I was pure price action type trader. I started to develop some kind of setups. Um, the work of Lance Beggs was pretty influential to me. Um, starting to be exposed to seeing the crowd, right? Rather than just candlesticks, starting to understand the psychology behind things and who's trapped what, right? And starting to understand the concept of stops being run, right? So that kind of teed me up to make a pretty graceful entry, just through getting exposure on, forums and places like that, to profiling, volume profile, market profile, fairly synonymous. And so that leads me into, well, what's all this profiling thing about? And I think the root of profiling is auction market theory. So that led me to kind of study AMT and really begin to connect a lot of the psychology and markets being crowds, right? An auction process of people, right? Machines created by people. Um, and so all of a sudden, I was connecting these dots between the price action stuff I developed, and then the overall auction process, and beginning to see things in terms of kind of value, right? Almost everything I do is relative to value on one time frame or another or multiple, right? Whether that's VWAP derived value, whether that's market profile value, whether that's volume profile distributions, whatever the case may be. I look at value across timeframes, and that dictates my analysis. So that's kind of where I landed. And then I think the last piece of the puzzle that I added was order flow. And so now it's like I got this so much better macro type view of context, and context is everything. Well, then on the other end of the spectrum, I started to learn about what's going on kind of shorter term, right? Helping with timing and seeing what's going on, inside of a bar, the strength of buyers and sellers, and that whole world. So to me, I can now dimensional, to take a term from, what was his name, Alan Farley, the master swing trader back in the day, 3D type vision. You have your higher time frame context, you have your trading time frame in which you're kind of analyzing some key, are we making a decision within the context? And then you have a lower time frame, which to me is then order flow, to help kind of really dial things in and get a more granular assessment of what's happening at the hard right edge, and when and where we want to put risk on and take risk off. So anyways, that's kind of the evolution of my trading. The most recent thing, and what I think I've been working on most over the past 8 months, and I'm ballparking, is some stuff with options, right? So I have almost both a desire to kind of slow down my trading, even though I find it really hard to follow through on that desire. I have other desires as well, I suppose. As well as layer something in incrementally, right, on top of what I'm doing. First get better, then get bigger, then get broader. So I think right now I'm focused on broadening the scope of what I'm doing. And so I do some options writing typically, to express some swing trade ideas and doing some kind of short-term skills, NADRO stuff, um, in order to delta hedge those exposures. And I'm very happy with the development there. So, I'm reading books on options. I'm still learning, right? I'm multiple, not multiple decades, but a long time in, coming up on 2 decades in markets, and yeah, still learning, still growing. Uh, Doru asks, are the legs from the overnight session as important for rhythm as RTH legs? Do you use them in the same way? Great question. I think for active futures products, the answer is yes, you can use them um, pretty much interchangeably. In fact, some of the pre-market stuff, when there's good activity, is probably more important than the rhythm from the prior pit session, but they're both valuable. You're not going to go wrong, you know, finding that happy median or mode, of what you're seeing as kind of the current volatility in terms of rhythm for your trading time frame. So great question though, but I certainly I tend to kind of focus on what's happened most recently. So in a lot of cases coming into the open and stuff, that's going to be some of the overnight rotations. Now, per usual, if there's a huge rotation, which sometimes, especially on a volume chart, guys, in the overnight session, it looks like one large rotation. Pull up a 3-minute chart instead of a 4,000 volume chart, for example, for the S&P, and you'll see more granular rhythm because there's less volume overnight, and the time is going to open up kind of and look shorter term into those rotations. And again, the main point there was, as usual, I don't, I understand that a very large rotation or a very short rotation is on the tails of the distribution of rotations. So that doesn't really factor into the kind of again, I don't do this quantitatively, guys. It's all, eyeballing it. But again, the kind of the average that I'm using. Marvin says, hello, Merritt. Is it correct to trade narrative with short-term rhythm acceptance? It is. It's just an aggressive form of doing it. You just have to understand if your acceptance is on kind of your trading time frame and that rhythm, at times that, well, almost always, that is going to be on the contextual time frame, nowhere close to a true change in acceptance. Whereas, the more conservative approach is to get the acceptance change on the actual contextual time frame, and then go use your short-term charts to trade, truly what is. So it's just a form of aggression. And, we could talk all day here on this about balancing that, but it's situational, right? If you've got a ton of confluence on 4 time frames and you're considering the acceptance picture is let's call it micro because it's on the intraday time frame on one contextual time frame relative to one contextual time frame, guess what? Be aggressive, go for it. You have so much on other time frames which is already totally valid and in your favor. So, balance that aggression with the strength of that overall narrative and the confluence across timeframes you're looking at. If you've got one reference that you're really excited about trading and no other supporting cast for that idea, and you get micro by using trading time frame rhythm for the acceptance read, you're probably going to have a problem. All right, one moment. All right, sorry about that. Um, Sorry, I don't know how to pronounce this name. It looks like Chow, um, but I'm not sure. I'm pretty good at building narratives and what if scenarios, but execution always bugs me. Sometimes pullbacks are shallow, sometimes they're deep. How do you figure out which type of pullback it's going to be? um, I'm laughing with you, not at you. Uh, I've included some examples. Last pick, blah blah blah. So, um, the answer is, unfortunately, we never know, but we can use some reads on, especially in this case, short-term conditions as well as contextual. Let's talk about both, to kind of not know. Again, it's really important that we're not saying um, we know anything, but we are saying we can use both contextual and short term to kind of figure out, the combination of those things to figure out what tactics, right, or what strategy we might want to kind of deploy at any given time. So, contextually, let's start there. Contextually speaking, sometimes we have a really key level that's broken down, and let's say it broke down, in a swift type move, um, and it hasn't been retested on any major time frame, right? The rhythm of a higher time frame at all, right? Maybe intraday, let's say the level looked like this and it did, that, right? And kind of retested it. But on any major time frame, there's been actual no, with that rhythm, any type of retest. When that's the case, a lot of times you when you consider just shorting this next momentum shift and going with kind of this breakdown and trend, a lot of times you can get caught here, because guess what? The bigger picture might need to get their pullback, right? So you end up on the shorter time frame with something that looks more like a complex pullback, right? We've all been there. You get stopped out, you try it again, you get stopped out, like that kind of thing. So a lot of times that's contextual, a very key area that has recently been broken and has been, not retested yet or whatnot. Well, let's put ourselves in that situation again. Here's that same level. Um, CAIO is pronounced Kyle. All right. All right. I love it. Are you sure the L's in there? Are you sure it's not Kyle? Kyle? I'm literally asking someone if they're sure how to pronounce their own name. All right, it's Kyle. Let's go. All right, so let's say it does this same breakdown again, but now we're going to kind of read some short-term tells. Order flow is super weak in what I'm about to show you, and price action is like really, really struggling and kind of what we might call flaggy, right? Guess what? I might be really interested in shorting a breakdown right here. So you see how I'm using, okay, it's a contextual situation. The most likely situation is that we need a deeper pullback. But if price is attempting short term the deeper pullback and is really doing a miserable job of that, guess what? We can take that short term type trade that makes sense there. So, it's not a simple answer, and the best thing is what I led with there, and we never ever know. We truly never know. Let me place a protective stop here. I am trading. Involved in a little Bed Bath and Beyond here. Okay. So great question. So he says, my problem is not contextual versus short term. It's when it gets there. Could you please check the picture on the tweet? Okay, so in this case, the pullback never comes back to your line in the sand. Acceptance higher, false breakout lower. I never know if it's going to test the previous range high or the current range low. Again, we're never going to know. So you keep using that word both in your question to me and in your stuff on Twitter around needing to know what's going to happen next. You need to know what's good enough for an entry for your process, right? You need to have entry triggers that trigger in certain contextual situations, obviously. And you do the best you can, because that's all we can ever ask for. So if you've got a good read on context, if you've got a good read on short-term stuff that I'm describing here, then you that's enough. You can be successful with that. So I just think that for example, if it doesn't come back to the line in the sand, you could use, let's say half of your allowable risk on your box type, short-term range. Use the failed breakout lower out of that box, right? If you've already got that box, to me, I don't believe you did at the time of the breakdown. That's hindsight. But anyways, I hope that's helpful in some way. Okay. Pax says, I was having a lot of success when the market was super volatile from January to June. And now I'm struggling a bit with ES slowing down, taking smaller scales, taking a lot more heat on my core positions, oftentimes getting shaken out along the way, re-entering a crappy entry, then stopping out. To make it worse, seeing price reach my original destination an hour or two later. Before it used to take 15 minutes. When the market's more normal, do you just tell yourself to be more patient, or do you have to take smaller profits? How do you mentally prep? So you have to shift tactics, right? If the market is drastically different, whether it's one market to the next, or whether it's volatility regimes within the S&P itself, tactics have to be different. I disagree with you that this is a quiet market. Sure, did we spend an hour today quiet in the S&P? Yeah. But this is not a quiet market. This is not a low volatility market. Have we had some grind up in the past week? Yes, we've seen a little grind up, which we haven't seen, pretty much, as you mentioned, since, for a year, or since 2020 almost. So yes, but it's very easy to see grind up when grind up is happening, right? We can see it in the volume. We can see it in the lack of the rotation sizes, right? We can see it. Now, it might take you a stop out or two to adjust, but that's trading, right? We don't know what the conditions are when they're changing at the hard right edge, right? We trade what is. We don't predict. We don't know what's going to happen next. So, again, I want to push back a little bit on there's still good volatility. And secondarily, I want to say that, you want to have different tactics, different stop placements, different trade management schemes that you can pull, out and deploy. I think that's super important. People, especially, my goodness, I can't tell you how many times I see traders and I start to dive into their process, and they use fixed stops in terms of, my stops are 4 points in the ES, right? My stops are 20 cents in crude oil. Well, guess what? That doesn't work across changing volatility regimes. It doesn't. It works for what's maybe normal, or it works when the new normal is high vol, and that's what works for that. You have to be dynamic with stops, targets, any form of trail. All of that has to adjust with the type of trade, whether it's mean reversion, whether it's imbalanced, with the volatility at hand, the rotation sizes. It has to be dynamic if you want to really, really be good at trading futures day in and day out, I think. All right, last question. Our half hour is up here. Good old Tanush says, since you've been involved in the markets for so many years, you must have some opinions on the different macroeconomic conditions. What's your opinion on the current market conditions, and does it have any effect on NADRO trading and your trading in particular? Has there been a difference in the last couple of years? For example, does NADRO perform better during quantitative easing compared to quantitative tightening? Are there reference areas tested with more structure and order? Tanush, you're a smart guy. I really appreciate the question, but I'm not that smart. After taking my licks and learning certain lessons early on, like during my college years or just after, I really did rid myself of using fundamentals. I truly did. So could I talk enough to be dangerous, to make myself look like a fool in front of people who really know about what's going on with interest rates or inflation or Fed policy, or all kinds of things like yes, but I don't use it one iota in my trading. Do markets tend to go, do US indices tend to go up more when there's quantitative easing being done? Yes. But is that ever going to come in? Am I going to do something against the CVA or a nice confluent narrative with VWAPs because quantitative easing is present or not present? No, it's not remotely a thought in my head. So we could go back to the first sentence in your question, where you say you must have some opinions on the different macroeconomic conditions. And the answer is no, I don't. I do not must. So I think that that's one of my convictions as a trader. And you'll find all traders who have, I like that, Nick. You'll find all traders have some deep convictions that they have developed over time, typically through pain, right? And I'm no different. So that's one of mine. I don't look at what the CPI number is. I don't look at what the interest rate decision is when FOMC day is here. I don't look at what crude oil inventories are when I'm trading crude on a Wednesday. I don't. And I don't develop themes or anything that I think is happening or should happen with economies or governments or inflation or interest rates or anything. So I just don't. All right, guys. Wonderful time. Per usual, great questions per usual. I'm sorry that we didn't get to, my goodness, a lot of questions, about 24. Thanks for being here. Use all caps and say, hey, question from last week when you post it next week, and I'll try to get to it. Cheers, everybody. We'll see you all around.